Hey, good afternoon, everyone. I was just trying to hold on a bit because I can see that a lot of your colleagues haven't joined, which is why I'm holding on. I've been here, I've been around. So I hope you guys are well and okay today. So today we would continue with our class on financial instruments, which we started last week. We cannot finish it today, but I know we will finish it next week or on Wednesday. So we started financial instruments on Wednesday, and we looked at series of issues around IAS 32, and I was able to get IAS 32 to a reasonable extent. At least we looked at definition of items and we deep dived into the presentation and classification of financial instruments into debt or equity instruments. Basically, that was the part of IAS 32 that we looked at last week. And in looking at IAS 32, we started with the definition of what financial instrument is. And I told you that financial instrument is a contract or any contract that gives rise to financial asset of one entity and financial liability or equity instrument of another entity. We spent a lot of time on this definition, and I went further to define financial assets, financial liabilities, as well as equity instruments. We then solved series of questions. For financial instruments, I told you that for us to have a financial instrument contract, there must be at least two parties, where one party must have either financial liability or equity instrument, and the other party having financial asset. I told you that the party that has financial assets is usually the investor, the person dropping money, while the party that have financial liability or equity is the person collecting money. I also told you that to identify whether a party has financial liability or equity majorly depends on the instrument that party is issuing. If a party is issuing a debt instrument, be sure that most often than not in all cases, because what determines this split is the substance, but most often than not, when a party issues a financial liability or a debt instrument, then that party will have a financial liability. When it's an equity instrument is issuing, then that party would have an equity instrument. And I told you what debt instruments are, like loan notes, debentures, commercial papers. These are debt instruments. They are used to borrow money. But equity instruments are share capital, your ordinary share capital, maybe your preference share capital. These are used to raise money as well. We also went further into defining what financial asset is, as well as financial liability. I told you that financial asset is cash, equity instrument of another entity, and contractual right to receive cash. And I told you that financial liability is a contractual obligation to deliver cash. And I told you that equity instruments are majorly ordinary share capital. We solved some questions, which every one of you participated. The class was highly interactive. Everyone set their mind. Then I ultimately came in to give explanations around what it should be and what it should not. This particular question helped us in understanding when an entity has a financial asset or a financial liability, and whether there is a financial instrument contract in the arrangement. This question helped us to do that. This question was a more technical question because a past question, and this helped us in understanding how to classify the instrument, the issuer has issued, how to classify it into whether it's a financial liability or an equity instrument. So we looked at these three scenarios. We explained it critically. And I gave you these as assignments. Some of you have done it. Some of you that sent it early to me, I have shared the solution with you. For those that are sending theirs today, I'm always in class from morning. I'm just finishing a class, then joining your class again. So of course, I won't have time to look at it within that period. So for those of you that have not done it, I would strongly advise that you look at it because it's not beyond what we have looked at already in this class. This will further expose you to how to classify an instrument into either financial liability or equity instruments. Do it, then I share the solution with you. Today, my objective is to finish up recognition and measurement of financial instruments. That's my objective for today. That's what I want to finish. So let's see if we will be able to achieve that. First, I'm going to start with recognition and derecognition. By now, you should know that when we talk about recognition, we are talking about the inclusion of an item or an element into the financial statement. In this case, the item we want to recognize into our financial statement is financial instruments. So we're looking at recognition of financial instruments. At what point can you recognize, can you include a financial instrument into your books? The standard says that you can recognize financial instruments in your financial statement when an entity becomes a party to the contract. As soon as an entity becomes a party to the contract, then you can go ahead and recognize that transaction in your books. And it makes sense because we said financial instrument is a contract. That was the line of definition. So before you can recognize it in your book, as soon as you become a party to that contract, then go ahead and recognize that transaction in your books. And a party can become or an entity can become a party to a contract, either at the date of commitment or the date of agreement. So the date you make an agreement or you enter into an agreement with the counterparty, you can be the date of the contract, can be the date where you become a party to that contract, or the day you drop money that, okay, invest this money for me. The date they sign the agreement or the date of commitment, that is the date you become a party to that contract. And it is at that date that recognition of financial instruments would commence. The next one is derecognition. So derecognition is the removal of an item or an element from the financial statement. Removal, derecognition. So at what point can you derecognize items? In this case, let me start with financial assets. When can you derecognize financial assets from our books? Should be straightforward. So we mentioned that financial asset is cash, equity instrument of another entity, or a contractual right to receive cash. So at what point can you derecognize this? Looking at that definition, we can say that, or even the standard said that, you can derecognize a financial asset when the contractual right to cash flows. When the contractual right to the cash flows has expired, or when there is a transfer of substantial risk and reward, attributable to ownership of the financial asset, then we can derecognize that financial asset from our book. So in case the examiner asks you that before you can derecognize a financial asset from the books, what are the criteria that must be met? These are the two. Number one, when the contractual right to cash flow has expired. You have a financial asset and you have collected all the cash flows relating to that financial asset. You have collected all your cash flows. Then you recognize it from your books. But not only that. Number two is that there must be a transfer of substantial risk and reward attributable to ownership of that financial asset. When you have transferred risk and reward of that financial asset, then we can say that you can derecognize it. And when we say you are transferring risk and reward, it means that there is an unconditional sale of that financial asset. Meaning you have sold it. You have sold the financial assets, or you sold it, sale of the financial assets, with an option to repurchase it at its fair value. At the date of repurchase, of course. This too shows that you have transferred risk and reward. When you sell your financial asset, when you sell your shares, for example, now, or you sell your treasury bills, that means you have transferred risk and reward. Then remove it from your books. Or you sold the financial asset, you then agree with the buyer that you are going to repurchase it at fair value. So the fact that you are buying it back at fair value also confirms that you have actually sold. You just want to buy it again later at the market price, which is good enough. However, when you sell and you agree with the buyer that this item I'm selling to you, this asset I'm selling to you, I'm going to buy it back from you at a fixed price. If you agree with him that you're going to buy from him at a fixed price, that is not transfer of risk and reward. That is not sale. You cannot recognize such a scenario as a sale because you are buying it back at a fixed price. Not at the market price at the date you're buying it back, but at a fixed price. So there is, it shows that you still have control of that item that you say you're selling because you are still dictating how much you buy it back. It shouldn't be that way. Okay, so this is it around the recognition of financial assets. Another one is financial liabilities. How do you recognize your financial liability? Again, looking at the definition of a financial liability, which is a contractual obligation to deliver cash. So you can recognize that financial liability when the obligation in the contract has been extinguished. That is, it's settled, that is settled, cancelled, or even expired, even transferred, whatever it is. That is settled, is cancelled, or expired. That shows that you have extinguished that obligation. When you have settled it, when you have cancelled it, or when it has expired. There was a question they asked you one diet like this. They gave you a long scenario, and the examiner mentioned that an entity borrowed money. It borrowed, let's say, like 100 billion. They borrowed money. And this money they borrowed, they're supposed to pay back in like 2 years' time. And they haven't paid back, right? But after like 1 year, they already have that money. They already have it. And they are ready to settle, but they have not settled, but the money is there. They already kept it that we can settle as soon as that period comes. So because they feel that because the money to repay that liability is on ground, for that reason, they do recognize that financial liability. That was what the scenario told us. So they ask you guys to advise them. Of course, we advise them not to recognize that financial liability because they have not extinguished it. It's not settled, it's not cancelled, it's not expired. So why would you want to recognize it? Because you have the money to repay. Right? So to answer that kind of question, you give them the definition and you talk them into ensuring that they don't recognize it and they have to continue to recognize that financial liability. Okay, let's look at some questions. How many questions are here? Okay, let's solve these two questions first. Just to be sure that I have students in this class, because I've been talking for the past 30 minutes. So, can somebody read this question for us? This question right in front of you.
Can I read now?
Okay, please go ahead.
Okay, question. XYZ Bank holds a portfolio of trade receivables amounting to 5 million naira. To improve its liquidity, the bank enters into an agreement with ABC investors, selling the receivables for 4.8 million naira. Under the terms of the agreement, XYZ Bank transferred the legal rights to receive cash flows from the receivables to ABC investors. 2. However, XYZ Bank provides a guarantee to ABC investors that if any of the receivables become uncollectible, XYZ Bank will compensate ABC investors for the loss. 3. The bank retains the right to repurchase specific receivables under certain conditions required based on IFRS 9 financial instruments. Should XYZ Bank recognize the trade receivables from its financial statements? Justify your answer by evaluating whether the risks and rewards of ownership have been transferred.
Okay. The question says that based on IFRS 9 financial instruments, should XYZ Bank derecognize the trade receivables from its financial statement? And justify your answer. If you look at this question, XYZ Bank holds a portfolio of trade receivables amounting to 5 million. Then XYZ Bank needs money, so he wants to improve its liquidity. So the banks enter into an arrangement with ABC investors by selling their receivables for 4.8 million. And these are the agreements. Number one, XYZ Bank transfers the legal right to receive cash from the receivables. Number two, XYZ Bank provides a guarantee to ABC investors that if any of the receivables become uncollectible, XYZ Bank will compensate ABC investors for the loss. Number three, the bank retains the right to repurchase specific receivables under certain conditions. Okay, good. Now, first is that this trade receivables, you know that is a financial asset. So the question is that should he derecognize it? You learned that financial assets can only be recognized, can only be derecognized when the following criteria are met. Number one, the contractual rights
of the cash flow has expired.
Cash flows has expired. Number two, there
There's
is
a transfer of substantial risk.
Of substantial risk and what? And reward. In this case, have we met these two criteria? Let's check it. Number one, we're told that XYZ Bank transfers the legal right to receive cash. So, since XYZ Bank has transferred the legal rights to what? To receive cash. This shows that it has transferred, or this shows that the contractual right to cash flows, the contractual right to receive cash as what? As expired. So it has met this condition. But we need to also meet these conditions where there is a transfer of substantial risk and reward. We have to meet those two. And I told you that there is a transfer of substantial risk and reward where there is an unconditional sale of that financial assets, or where there is a sale of financial assets, but there is an option to repurchase at fair value. In this case now, have we transferred risk and reward? Let's see. They were told that XYZ Bank provides a guarantee to ABC investors that if any of the receivables become uncollectible, XYZ Bank will compensate ABC investors for loss. Now, again, since XYZ Bank will compensate ABC investors for any losses arising from the trade receivables. This shows that XYZ Bank retains significant credit risk. Hence, they have not transferred substantial risk and reward. So since they said if there is any loss or if any receivable becomes uncollectible, they said XYZ Bank will compensate. That means XYZ Bank still has some level of credit risk attached to that trade receivables. For that reason, he hasn't transferred risk and reward. For that reason, he has not met these second conditions. So, following from the above, the two conditions for the recognition of financial assets has not been met. The bank cannot therefore derecognize the trade receivables. And that's the solution to this question. I hope that is clear. Let's move to the next question. So who is reading this? Yes, Ifeoma.
So what about the number 3? Can you explain how we explain this in number 3?
Okay, so automatically, since I've seen that these two already shows, so this one does not determine anything. Anyway, the bank retains the right to repurchase specific receivables under certain conditions. So this one, they didn't give us enough information, and whether it's enough or it's not enough, it won't impact our decision. But what this is saying is that they can buy back the receivables under certain conditions. So we cannot even use this one to make judgments because they did not tell us whether they will repurchase it at fair value or whether they will repurchase it at a fixed price, because that's what will determine whether they have transferred risk and reward. If they are repurchasing it at fair value, then we can say, okay, they have really transferred risk and reward. If they are repurchasing it at a fixed price, we'll say no, they have not transferred risk and reward. So this third point is not even sufficient enough. But whatever it is, this one already tells us that we didn't meet the second condition. And before you can derecognize a trade receivables or a financial asset generally, these two conditions must be met. Okay. You know that I'm still going to share this working note with you. So you're going to see all these solutions as part of it anyways. Okay. So can somebody read this second one to us?
Question. ABC Corporation, a large manufacturing company, holds a portfolio.
He's not here.
Can you hear me?
He's not here.
We can hear you. Go ahead, please.
Okay. ABC Corporation, a large manufacturing company, holds a portfolio of long-term loan receivables amounting to 50 million naira. To improve its liquidity position, ABC enters into a securitization transaction with XYZ Special Purpose Entity, structured as follows. 1. Transfer of loan receivables. ABC transfers the loan receivables to XYZ SPE in exchange for immediate cash of 45 million naira. 2. Risk retention. ABC retains a 10% first loss position, meaning it absorbs the first 5 million naira of any credit losses on the portfolio. 3. Servicing of loans. ABC continues to service the loans on behalf of XYZ SPE, collecting payments and handling delinquencies. For this service, ABC receives an annual servicing fee of 1% of the outstanding loan balance. 4. Variable consideration. If the loans perform better than expected, that is, credit losses are lower than projected, ABC is entitled to a performance-based fee equal to 20% of any excess collection over an agreed threshold. 5. Legal transfer of ownership. The legal rights to the loans are transferred to XYZ SPE. Creditors of ABC cannot reclaim these assets in the event of ABC's insolvency. Required. Under IFRS 9, should ABC Corporation derecognize the loan receivables from its financial statements, provide a structured analysis using the derecognition criteria, considering risk and reward transfer, control assessment, and potential ongoing involvements.
Okay, thank you. So similar to the first question, this one also looks at ABC Corporation, saying that it has some loan receivables amounting to 50 million. We're now told that to improve its liquidity position, ABC enters into a securitization transaction. You know, a securitization transaction is just where you want to monetize your receivables, right? You need money. So they give you money and you give them your trade receivables. So that's part of what securitization means. So ABC enters into this transaction with XYZ SPE, and this is how the number one. It's a transfer of loan receivables, which means that ABC transfers the loan to XYZ SPE in exchange for immediate cash of 45 million. I think that's clear. So they are giving ABC Corporation cash immediately, which is what he wants anyways. Then risk retention. We're told that ABC retains 10% first loss position, meaning it absorbs the first 5 million naira of any credit losses on the portfolio. So ABC retains 10% first loss position, meaning it absorbs any first 5 million naira loss on credit losses. So saying that if there is credit loss, if the securitization vehicle or the SYZSP, okay, if they're unable to recover those loans, so ABC is saying that I would suffer the first 5 million, right? I would suffer the first 10% of that default. Thirdly, servicing of loans. It says ABC continues to service the loans on behalf of SYZSP, collecting payments and handling delinquencies. For this service, ABC receives an annual servicing fee of 1% of the total outstanding balance. So that means ABC is still helping them to collect payments from the loan. It's still helping them to go after those loans that refuse to pay back. And for this service, it's agreed that they will give him a service fee of 1%. Additionally, we have variable consideration saying that if the loans perform better than expected, that is, credit losses are lower than projected, ABC is entitled to a performance-based fee equal 20% of any excess collections over an agreed threshold, saying that if this securitization vehicle is able to recover the loans, they're able to recover all their money, they said they will give him a performance-based fee. They will give him a reward if they're able to collect or recover those loans. And they said it's 20% of any excess collection over an agreed threshold. Finally, legal transfer of ownership, saying that the legal rights to the loans are already transferred to XP, and creditors of ABC cannot reclaim these assets in the event of ABC's insolvency. Okay. Similar to what you've learned, the first thing you need to quote is that financial asset, because this loan receivable is a financial asset. So financial asset can be derecognized. Financial asset can be derecognized where the following criteria are met. Number one, the contractual rights to the cash flows has expired. And number two, there is a transfer of substantial risk and reward. From the question, the legal transfer of ownership, this one, shows that the contractual rights to receive cash has expired because we're told that the legal right to the loans are transferred to XYZ and ABC cannot reclaim the asset. So he doesn't have right to the cash flows anymore. That has expired. Additionally, since ABC Limited retains 10% first loss position, since ABC Corporations retains a 10% first loss position, which shows that in case of credit loss, the entity will bear a significant credit risk. This clearly shows that the entity has not transferred substantial risk, because 10% is substantial. 10% first loss position, that's hugely substantial. Moreover, ABC Corporation will also get performance-based fee on excess recovery. Which shows that the entity still enjoys the reward attributable to these financial assets. It is important to know that the service fee, this one of 1%, the service fee of 1% for the services rendered by ABC Corporations does not affect the recognition of the financial asset. So it doesn't impact our decision. It can recognize this fee in its books. It can recognize this fee as an income in its books. So, I mean, he's rendering a service, so you should pay him for that. Now is a separate service entirely that it has nothing to do with due recognition. Okay, so following from the above, ABC Corporations cannot derecognize the financial asset because it hasn't transferred the substantial risk and reward attributable to ownership of the financial assets. However, since it has collected 45 million, this amount will be treated as a financial liability in its books. Because that means he has an obligation to pay it back. You know, he collected 45 million. Now, okay, give me 45 million. That is that's a liability. The same thing here too. This first one that we did, this 5 million he collected, or this 4.8 million he collected, is a financial liability in his books because it doesn't meet the recognition criteria. Okay, so that's the solution to this question as well. All right. Do you have any questions?
Hello, sir.
Yes.
Hello. How is
Yeah.
it a liability now? No, is it not you said it's a financial liability. I thought it's financial asset. Since it did not meet the criteria.
We are talking about the money he collected. The 45 million he collected. Okay, if you debit bank, what will you credit? Ordinarily, you should credit the financial assets to derecognize it, but we are saying no, you cannot derecognize it. That money you collected, since it has collected 45 million, this amount will be treated as a financial liability. It's the amount you collected we are talking about here. The 50 million still remains financial. You will not recognize that. That one is still in his books. But since he has collected money, that money he collected is a liability in his hands. He has to return it.
Okay, sir. Okay. Thank you.
Yeah.
Hello, sir.
Yeah.
No, when you started answering the question, you just pick it from the bottom, not from the way it was numbered. I hope it doesn't mean.
And it doesn't mean, since you'll have read the question, and the reason I did that was I wanted to follow through with the way this thing was arranged, the recognition criteria. I wanted to clear this one to show that yes, his contractual right to receive cash has expired, and this is the only one talking about that. Okay, that was why I cleared this one. Then I then faced these other ones. Okay.
Okay.
So ultimately, I touched on everything, but it doesn't have
Yes,
to.
I understand that.
Yeah.
That's fine. Thank you.
Okay. Any other questions? Okay. Since there are no questions, it means we can move forward. This part, I mean, I can like asking this, the recognition thing. They like asking, and it's always like this. It's never more than what I've shown you. So, before I forget, I talked about the recognition of financial assets. I talked about the recognition of financial abilities. I talked about the recognition of equity. Because financial instrument, there is financial asset, there is financial liability, and there can be equity. The reason I didn't talk about it is that according to CAMA 2020, Companies and Allied Matters Act, you are not supposed to derecognize your equity as a going concern business. We don't expect you to derecognize your equity is your share capital. So, and one of the assumptions in the conceptual framework or in reporting is that this company will continue to operate into the foreseeable future. So we don't see a scenario where you want to de-recognize your equity instruments. The only case where you would have to do that is where the company is shutting down, the company is closing down. That is the only scenario where you want to return shareholders' funds. So which is why I didn't really mention it at all. Okay, I just needed to let you know that. I hope that is noted. Okay, then now let's go to. Yes, go ahead, please. I'm with you.
Sir, I want you to help us use the case of Duteco in First Bank to stress much of this thing, since that is what is happening now as far as this financial instrument is concerned.
Yeah, good. So if you look at that scenario, you see that that within First Bank, for example, now, Otedola acquired his holding is now close to almost 35%, I guess. Is huge, and I think the former chairman of Otedola is really selling. I mean, it looks for me like a transfer of shares between those two giants. So that is being, I mean, they're operating in the secondary market in the stock exchange. I mean, what Tedola is just doing is just buying financial assets. He's buying financial assets. The bank remains the bank. He has nothing to do with the bank. He's just there. It's really stable. He's just acquiring financial assets as far as Otedola is concerned. As far as the bank is concerned, nothing is really changing because this is happening in the secondary market, and nothing much is happening for them in terms of what we are discussing today. And the recognition has nothing to do here. There is no recognition happening here right now because they are just buying shares in the secondary market. The total composition of the share capital of the company hasn't changed, and so things remain the way they are. Yeah, Christopher even said it's even 40% now. That is massive. That is huge. I mean, 40%, that's huge. So Ahmed, it doesn't really, the company is not recognizing anything because the share capital composition, the total share capital base of the company is not changing. It's just the way it is. Just that some set of people that have huge cash flows are buying shares in the secondary market. They're trading in the company's shares. Nothing is changing except the shareholders register maintained by the registrar. Nothing is changing in the books of the company. Nothing.
Thank you, sir.
You're welcome. Okay. Now, let's look at measurements of financial instruments. So, for measurements, of course, again, I will look at measurement of financial assets, measurement of financial liabilities, and also measurement of equity instruments. Because these are, when we say financial instruments, we are talking about these three. Let me start from the very easy one. That won't take us a few minutes. So, measurement of equity instruments. So, in Nigeria, share capital are measured at nominal value. So the nominal value of shares can be gotten from CAC documentations, either from 7A or from 2A, I guess, CAC documentations. So you will have registered your nominal value at there. So anything that goes into your books as equity, as share capital, you must recognize it at its nominal value. So if you are issuing 10,000 naira shares, you need to check your CAC document that, okay, what was the nominal value we recognized when we were registering the company? That is what would be recorded as share capital. Any amount above that nominal value shall be recognized in share premium. Okay? At your level, we assume you know that. So you will never find a question like that in the exam because they believe it's elementary accounting. Now, let's go to the next one, which is financial assets. So how do you measure financial assets? Remember that financial assets are three. I taught you when I was defining financial assets to you, I told you that financial asset can be cash, it can be equity instruments of another entity, and it can be contractual rights to receive cash. So how do you measure cash? Your cash is your cash. So there is no special measurement basis. As soon as you are able to identify your cash, then that is it. As soon as you're able to identify your cash, recognize it, that's the amount. So this one, very straightforward. So no issue around that. The second one, equity instrument of another entity. So this is where an entity buys shares. So this is where you buy shares in another company, in another entity. How do you recognize that? How do you measure that, I mean? And contractual right to receive cash. This is where you lend money to another entity. Yeah, how do you measure that? So these are the two that we would carefully address. Let me start with equity instruments of another entity where you buy shares. So let me use a scenario. Otedola buys 2 million ordinary shares, 2 million ordinary shares in First Bank PLC at 5 naira per share. How will Otedola measure this share acquisition? So when we are talking about measurement, you need to know that there's something we call initial measurement. Initial measurement. Initial measurement is the measurement at the date of acquisition. Okay? So let's assume that this 5 naira is at 5 naira per share at the date of acquisition. Let's say the date of acquisition is 1st January 2025. So the standard says that financial assets that is equity, let me call it equity investments. When you buy shares, that is equity investments are measured initially at the transaction price, which is the price or the amount that is paid for those shares. For those what? Shares. In this case now, in this question, the transaction price is the 2 million shares multiplied by what? 5 naira per share. That means we are going to recognize this at how much? At 10 million naira. We will recognize this at 10 million naira. And that is what we mean by transaction price, which is quite logical. To be precise, is very, very logical. Recognizing the equity investment at the price you bought it. That's the transaction price. Let's assume, because it doesn't stop there. In fact, there's something I need to mention before we move to the end. Note that when shares are acquired or where there is an equity investment, IFRS 9 requires that the investor must identify or must classify the investments by identifying its intention for the share acquisition. So, and this is done at the date of acquisition. So we are saying that whenever an entity buys shares, right? That is when there is an equity investment, IFRS 9 requires that investor must identify his intention for that share acquisition. Like Otedola now, at this date that he bought the shares, when he wants to put this 10 million naira in his books, he needs to identify his intention. And obviously, Otedola's intention is clear. He wants to be the owner of this bank. He wants to hold these shares for the long term. That's his intention. So, you see, there are two intentions that can happen. There are two intentions for buying equity instruments or for buying shares. There are two. Number one, to hold it for the long term, like in the case of $10 here, to hold it for the long term. Number two, to hold the shares for the short term or for trading. These are the two intentions. Is either you want to hold it for the long term or you want to hold it for the short term. You need to immediately identify that first, because the standard requires that you must classify the investment. It's important for us to know, because buying shares is different from buying equipment. Because when you buy equipment, everybody knows that you want to use it to manufacture for a very long time. For buying shares, you can decide to sell it anytime. So for that reason, it's important we have that information about what do you want to do with these shares. Are you buying it for speculation or are you buying it for the long term? So that when we are reviewing your account, we can make proper and appropriate decision on that basis, on that information that we have. Now, with this, when we know your intention, then we will say that if the intention is to hold the shares for the long term, then the equity investments will be classified at fair value through other comprehensive income. But if the intention is to hold, the shares for trading, for speculation, or for the short term, then in this case, the equity investment will be classified at what? At fair value to profits or loss. So this has to be done at the date of acquisition. You need to know, you know why you're buying this. There are some people that will buy shares and say, okay, let me keep this money. Let me just use shares to hold this money because I don't want to spend this money. They will now buy shares that, okay, after 2 years or after 3 years, I will sell. Maybe you want to buy land, you're saving for your house, and you don't want to keep the money in the money market, right? Then you go to the stock market. Now, okay, let me keep this money. Then I'll keep saving. When my money is ready, then I would sell and buy. That's holding for the short term. That is holding for the short term. But by the time you are buying shares and your aim is to become a member of the board, your aim is to never sell it. You want to become who is who in that company as a result of you accumulating shares. That is holding it for the long term. And you as accountants, you see, it's because I'm teaching you, that's why I'm using these layman terms that for the long term, for the short term. You as accountant, as soon as you see that a financial asset is classified at fair value through other comprehensive income, you need to know that, okay, this company has acquired this financial asset to hold it for the long term. You need to know. They will ask you in the exam now, so you have to know. So if you are holding it for the long term, you will see that it will be classified at fair value through profit or loss. So that means there are two ways in which you can classify your financial asset, either at fair value through profit or loss, or at fair value through other comprehensive income. Okay, so this 10 million now, with this information that I gave you, I don't have sufficient information here. So I can say that Otedola wishes to become a member of the board. So that is enough to tell you that he wants to hold it for the long term. So this 10 million on initial measurement now. So from the above question, so the 10 million will be recognized. The 10 million will be recognized as follows. So it will simply debit, let me call it financial assets, in brackets, equity investments. You will now say at fair value to OCI. That's 10 million. So when you see this in front of a financial asset, in front of an equity investment, this should tell you that they are holding it for the long term, not for the short term. When you see this, then, of course, you credit bank, since it's paying money, with the same 10 million. Okay? The 10 million will be recognized on 1st January 2025 as follows. So on initial measurement. So this is very important for us as accountants. It's important we know whether this guy is just buying these shares to sell it immediately or he's buying it for the long term. So still on measurements. Any questions? If you have questions, this is the time to ask before I move on.
Hello, sir.
Hello, Foma.
Hello, sir. Inside it should be recognized as a true OCI. So does it have any effect on the OCI? How can we treat it when we are treating it or when we are stating it on OCI? Does it come into it?
Yes, it does. We'll get there. It does. We'll get there. You're not there yet. But do you understand it up to this point?
Excuse me,
Yes,
sir, I have a
sir.
question.
Yes, please. Go ahead.
We're going through the jotting. You said that an entity can become a party to a contract either at the date of commitment or the date of agreement. The agreement, is it a written document between both parties? Or hello?
So when you buy financial asset or financial, like when you buy shares, for example, now, they will give you a share agreement or a share certificate, the date on that certificate. Or when you go to the bank to borrow money, there's always a contract, a term sheet that will show the terms where everybody will sign. That's the date of agreement. So the date on the contract, because financial instruments is a contract, the date on the contract, that's the date of the agreement. Any other questions? Okay. Now, I've clarified initial measurements. And I said that financial assets, that is equity investments, are initially measured at transaction price, which is the amount you paid for those shares. And I gave you an example of $10 million. And I also went further telling you that you need to classify the investments by identifying the intention for the share acquisition. And your intention is either of these two. And these two will determine how you classify it. If you are holding it for the long term, it will be classified at fair value through OCI. If you are holding it for the short term, it will be classified at fair value through P&L. What if you don't know? I mean, you could work with a company and your company buys shares and you're asking the people, now what's our intention for buying? They say, we don't know. They didn't give you sufficient data. In that case, you assume they are buying it for the short term. You assume they are buying it at the short, but if they are buying for the long term, they will know. So in that case, this one is like a default classification when you don't have sufficient data or information. Quickly, at the end of the year, let me call that, there's something we call subsequent measurements, which is where you are preparing your account, your financial statements. So these measurements at the end of the year, or which we call the reporting dates, is the same thing as the end of the year. So let's assume, or let me tell you the principle. So financial assets for equity investments is measured subsequently, that is at the end of the year, either in either of the following ways. In either of the following ways. Number one is either you're measuring it at fair value through other comprehensive income, that is, or you're measuring it at fair value through profit or loss. This goes to show that the same way you classify is exactly the same way you measure at the end of the year. It's the same way. So fair value through OCI, fair value through PL. Now, to give as an example, let's assume that this $30 question I gave you, we're now told that the share price at 31st December 2005 is 7 naira. So that goes to show that at subsequent measurements, that is 31st December 2025, the value of the shares will now be the 2 million shares times 7 naira. And that simply will give us how much? That'll be 14 million. That'll be 14 million naira. So shares that you bought for 10 million is now 14 million. Which means that you need to increase the value of these shares from 10 million to 14 million. So this means that we need to increase the value of the shares from 10 million to what? To 40 million naira. How do you do that? By debiting that financial assets. By debiting that financial asset that was 10 million naira before. Of course, it's an equity investment. Let me write it in full at fair value through OCI. Since Otedela wants to be a member of the board, we're going to debit it with 4 million. Since 10 million was in the financial asset before, now we need to increase the value to 40 million. So we debit the financial assets. Now we're going to credit other comprehensive income. And the only reason we are crediting other comprehensive income is simply because we are measuring these financial assets, and also we had classified it at fair value through OCI, which simply means, like Ruma or one student was asking, which simply means that whenever there is a change in fair value, that change in fair value will be recognized to OCI, to your other comprehensive income. That also goes for the fair value through profit or loss. If we had classified and measured it at the end of the year at fair value through profit or loss, that means instead of us crediting OCI, we will have mostly credited profit or loss with this fair value gain. Let me call it fair value gain.
Sir, please come again.
Okay. Again, the value at the end of the year is 7 naira, which means the value of our shares at the end of the year becomes 14 naira. This means that we need to increase the value of the shares from 10 million to 14. Remember, it was 10 million before because the share price was 5 naira before now. But now we need to increase it to 14 million. So how do we then increase it from 10 to 14? We will debit the financial assets that was classified at fair value through OCI. We will debit it with 4 million. Debiting it will increase its value from 10 million to 14 million because this is as good as increasing the financial asset value by 4 million. And we're going to credit other comprehensive income. We're going to credit other comprehensive income with a fair value gain with the same 4 million. And the reason is because this financial asset is classified and measured at the end of the year at fair value through OCI, which means that any changes in fair value in these shares shall be recognized to other comprehensive income. Any changes in fair value shall be recognized to other comprehensive income. And I mentioned that if, let's say, Otedola has decided to hold these shares for the short term, whereby he intends to sell it maybe next year or before the year end, we will have classified and measured this equity investment at fair value through POL. In that case, any gain, any changes in fair value we make would be recognized to POL. Would be recognized to POL. But because it is measured and classified at fair value through OCI, that's why we are transferring this gain to OCI.
Can I ask a question, sir?
Yes, please.
This accounting treatment for the nature of this transaction, is it applicable to globally, or is just within the Nigerian context, the Nigerian investment context?
It's globally. We are using IFRS now. IFRS in any country that uses IFRS. This is how it works.
Okay. Thank you, sir.
You're welcome.
Hello, sir.
Yes, Ahmed.
Yeah. Now, I haven't recognized it in the subsequent year when we have a increase in value. What if in the other year we have a reduction in a fair value? So how are we going to recognize it? Is it to be recognized in OCI or on profit and loss?
Okay, good question. Very, very good question. So it's still going to be OCI. Okay, it's still going to be OCI. So fair value through OCI, as far as financial asset is concerned, whether you make a loss, whether you make a gain, everything goes to OCI. Everything goes to OCI.
So this relates.
Go ahead, please.
So this relates to long-term investment. What of short-term? Is still going to be treated if there is any changes on P or L?
Yes, no.
Okay.
Finally, still on equity investments, is the treatment of transaction price or transaction costs. Let me call it transaction cost. That is acquisition cost or broker's fees. Broker's fees. You know that when you buy shares, you would usually use a stockbroker to acquire those shares. So Otedola will have probably used his broker. And there are a lot of charges that comes with those. They will get commission, it could be stamp duty charge, it could be the stock exchange charge. There are a lot of charges that comes with when you buy and sell shares. So if those charges are present, how do you treat those charges? So what I need you to know is that the treatment of transaction costs depends on the classification of the financial assets. That is, if the financial asset is classified at fair value, let me mnemonize it, at fair value through OCI, the transaction costs will be capitalized. That is, added to the initial cost, of the financial assets. But if the financial assets is classified at fair value through POL, the transaction costs will be expensed, that is, added to profit or loss. So, like in the question I gave you, if you had been told that Otedola incurred, let's say, 1 million to a stockbroker, that means initially, instead of recognizing this at 10 million, we will have capitalized that 1 million. That the value of the financial asset then becomes 11 million. And that's because this particular one is classified at fair value through OCI. So when equity investment is classified at fair value through OCI, it will be capitalized. That the transaction cost to be capitalized. But if it is classified at fair value through POL, the transaction cost will be expensed. Like that, something like that. So that's how it works. So that is the end of equity investments. So don't forget, I'm on financial assets. I've dealt with cash. I've dealt with this. Now let me deal with when you borrow money, which is debt instruments. Debt instruments. So when the financial asset you have is a debt instrument, how do you measure measurement of debt instrument? So let's go into that. So you know that I've already done the clarification that debt instruments are basically borrowing money. When you borrow money, you have a debt instrument. Then how do you measure that? So you see, let me call that initial measurement again. Initial measurement. So financial assets, in brackets, in this case, debt investments. Let me say debt investments. I'm done with equity investment. Is initially measured also at transaction price too, which is the price or amount paid for the investment, which is the amount paid for the investment. So let's say, for example, Wasiu acquired treasury bills. Wasiu acquired treasury bills of let's say 10 million at a nominal interest rate. You know, the face interest is called the nominal interest rate of, let's say, 10% or let's say 5% on 1st of January 2025. So when I say that it will initially measure it at transaction price, see, the above transaction will be initially measured at 10 million naira. It's very straightforward. It will be initially measured at 10 million, which is the principal value you paid or you invested on this debt instrument. Again, similar to equity investments, the entity must classify the financial assets, in this case, debt investments, by identifying its intention for making the investments. His intention for making the what? Its investment. Just like I explained to you on the equity investment. So we need to classify. IFRS 9 requires that on the date of acquisition, you need to classify the financial asset by identifying what's your intention. So there are two intentions here too. There are two intentions for making debt investments. And number one is that to collect interest and principal repayments at maturity dates, which is why most people would buy. I mean, it's just so that since they say, maybe it's 20% per annum, then people will key into it, majorly to collect interest. And then at maturity, you get your principal. Number two, to collect interest and principal repayment at maturity. Why this is coming here again is because collecting interest and principal is something that is constant when it comes to debt investment, except if it's an Islamic debt investment. Then that they say there is a share of profit arrangement there. But generally, for your exams here, collecting interest and principal repayment is constant. Okay. So the second intention is that since collecting interest and principal is constant, so in addition to that, it could be to sell as well as sell the debt investment, the financial assets in brackets, debt investment, where there is an opportunity to make a higher yield elsewhere. You know, some people can invest in T-bills or in any debt instrument for that matter, and they know that they are speculators, that they are just looking for where they want to make benefits, where they want to make benefits, that whenever there is an increase or whenever they see that another person has issued a debt instrument and they are going to get something, an higher rate, so they will just quickly sell the one they have and go and buy that one. They are just out there to maximize their own profits, right? And look for the best option for them. You see, these two together, we call it business model tests. These two together, we call it business model tests. So generally, when we say business model, is generally how a business makes money. That's what we call business model. So in talking about why you're making debt investments, that means we need to look at your business model. We need to test your business model. How do you intend to make money? So for debt investment, these are the two ways to make money: to collect interests and, of course, principal, and two, to collect interest and principal as well as sell. So these two comprises business model. And the second one is contractual cash flow tests. And this, what is here is that there is a contract. There is a contract that backs up the business model. Let me call it like that. That backs up the business model, either of the business model. So what we're saying here is this: before you can classify a debt investment, you need to consider these two intentions, these two classification bases. Is that two intentions or two classification bases? Number one is the business model test, which is how you intend to make money. Is it that you just simply want to collect interest and principal, or in addition to collecting interest and principal, you also want to sell where there's an opportunity to make an higher yield elsewhere? Not only that, number two, you have to show us, we need to be convinced, we need to see that there is a contract that shows how much interest you are earning and whether it is a tradable instrument that you can sell. So there has to be, what this is just talking about is there is a contract that backs up that cash flows, that interest and principal repayment. Of course, so this one is straightforward. You'll never find an exam asking you anything around this, because it's something that is always there, because there is always a contract. So what we just need to really learn is for you to spot which of these two is how the company is making money. Is it just collecting interest alone and principal, of course, or it can also sell if it wishes to? It can also, this is basically what determines classification. So if the business model is to collect solely interest and principal repayments, the financial assets, in this case, the debt investments, will be classified at amortized costs. Will be classified as something we call amortized cost. But if the business model is to collect, interests and principal repayments, as well as to sell the financial assets, then it will be classified at fair value to other comprehensive income. This one, you can keep writing it in the exam because it's constant, it's always there. So if you want to answer this one now, you say if the business model is to collect solely interest and principal repayments, and also there is a contract that shows that it will collect this interest, then the financial asset will be classified at amortized cost. For this one, if the business model is to collect interest and principal repayment, as well as to sell the financial asset, then, and also there is a contract that shows this, that you will collect interest and principal and you can sell, then you can classify the financial asset at fair value through other comprehensive income. See, there is a third classification. There is a third classification, which is at fair value through profit or loss. At fair value through profit or loss. This classification is used as a default classification. As a default classification, where the entity is unsure as to its business model, and also to avoid accounting mismatch. So if the entity is unsure as to which of this business model is using, whether it wants to sell or maybe just to collect interest and principal, is unsure, then we are looking at fair value through P&L. And also that when you have a portfolio of investment of financial assets, and this portfolio of financial assets, most of it are classified at fair value through P&L. So you can just decide, in order to avoid mismatching this portfolio instruments or this investment that you have, in order to ensure consistency, then you then decide that, okay, let me classify this one also as fair value to profit or loss. And also an entity can just decide, can elect that, okay, I want to classify this investment at fair value to profit or loss. It can do that. The standard allows that as far as this is concerned. So summarily, that means when you have a debt investment, a financial asset that is debt investment, there are three classifications. Is that you're classifying it at amortized costs, or you're classifying it at fair value to OCI, or you're classifying it at fair value to profit or loss. And ultimately, what determines your classification is your business model. Your business model is solely to collect interest and principal repayment, then you're looking at amortized costs. If you want to sell the financial asset, you're looking at fair value to OCI. And this, you can decide that, okay, this is what I want to do. I want to classify this at fair value to profit or loss. That also is allowed. So for this one now, this example I gave you, we're not told whether he wants to sell or whether he's not selling. So you would majorly use amortized cost in the exam. Okay? Don't assume fair value to OCI, through POL, right? If they want you to use this, it will be specified in the question. So for most part of your question, it's going to be between amortized costs and fair value to OCI. For most part of your questions, it will be these two. If the examiner really wants you to use fair value to OCI, it will specify that the company has designated that they want to classify this instrument at fair value to profit or loss. So in this question now, this amount that we are initially measuring at 10 million. So from the above question, the 10 million transaction price will be recognized as, so that means we're going to debit financial asset, in this case, debt investments. You now write at amortized costs. That's 10 million. You credit bank with the same 10 million. So that would really take care of that at initial measurement. So you have classified it properly. Again, at the end of the year, which you call subsequent measurements, which is measurements at the reporting dates at the end of the year or reporting dates. So there are also three classifications here, just like we learned. There are three measurement bases here. Is it that we are using, so let me write it. There are three measurement bases here. Is it that you're using fair value to OCI, or you're using fair value to POL, or you're using amortized costs. But the key thing is that as soon as, so the subsequent measurement basis must be consistent with the classification of the financial asset. Meaning that when you classify at fair value through OCI, it is expected that you measure at fair value through OCI. When you classify at fair value through POL, it is expected that you'd measure at fair value through POL. When you classify at fair value through at amortized cost, it is expected that you measure at amortized cost. So that's how this works essentially. Okay, so that's that for that. So this one now, so from the question above now, from the above question again, how do you then measure it at the end of the year? From the above question, it will be measured at the end of the year at amortized costs. And amortized cost is as follows. First, you would recognize your interests. You recognize your interest. In this case, the interest is straightforward and is simply, I think it's 5% times 10 million, which is 500,000. That makes it straightforward because we only have a nominal interest. So everything's straightforward. And with these interests, because debt investment requires that you're going to receive interest at specified dates, is specified. So we assume that we're going to collect this interest at the end of the year, thereby debiting bank, and we're going to credit POL with interest income, also with 500,000. Our financial assets at amortized costs remains the same at 10 million. It doesn't change. And this is how this works year in, year out. Year in, year out. Is straightforward for us. Like this. So if, for example, they haven't paid this interest, for example, now. So instead of debiting bank, we'll debit like a receivable, like an interest receivable. But debt instruments, we expect that they pay it on time. So debit bank. However, there might be some complexity. There might be some complexity when it comes to amortized costs in few cases as this. So let's assume the same question. Let me copy it. Where is the question? Let's assume the same question. I'll just add something. The same question. Wasu acquired treasury bills of 10 million at a nominal interest rate of 5%. We're now told that the period of the investment is 3 years. At which date the principal repayments will be 11 million. Now, see, this one is quite different from this, because from this one that I actually showed you, this one means that from year 1 to year 3, you will be recognizing interest of 500,000 every year. 500,000 every year in your P&L in such a way that at the end of the entire 3-year cycle, you will have made like 1.5 million interest since you're getting 500,000 every year. And also, they will pay back your financial assets. In this case now, the repayment of financial assets, in this case, will be at 10 million, the amount you invested, whereby you will debit bank, you collect 10 million, then you nil off the financial asset with how much? With 10 million, and everything ends. That's all. So the only gain you have made from here is just the interest over the 3 years, 500, 1.5, and that's all. But a complex scenario is this, different from that first one. Because here, at maturity, you are not going to collect 11 million. So you are not collecting that 10 million back. You're collecting 11 million. So see, from the above question here, right? Since the maturity amount is 11 million, this shows that in addition to the 5% interest, per annum, Wasiu will also get a premium of how much? Of 1 million naira at maturity. He invested 10 million and now they are paying him 11. So for here now, he's making 2 levels of interest. Let me call it that way. Number one is the 5% is going to get per annum. And number 2 is the extra 1 million is going to get at maturity, because they're going to repay him back 11 million. So how do we recognize this? Yeah, it would be wrong for you to recognize 5% interest per annum and you're waiting until maturity before you recognize this 1 million as income, because this extra 1 million this premium is also an income. So it would be wrong for you to not recognize this extra 1 million until maturity. For you to wait until maturity to recognize is something you need to start recognizing now, because it's an income that is generated over the 3 years, not an income that is generated in that year alone, because we actually invested for 3 years. And that's where the idea of amortized cost really makes sense. So amortized cost is in such a way that you're expected to find a way to amortize any extra income you're making from this investment. So in this case, you're making extra 1 million. So this extra 1 million, you need to also spread it as well over the 3 years. So in this case now, when you have questions like this, be sure that the examiner will give you the effective interest rates. And they will have worked it. They will give it to you. And this 8.08 is now the interest you're earning. Because this 5% now, yes, you are earning 5%, but for the fact that you are also going to make extra 1 million at maturity, it means you're making more than 5% effectively. So effectively, you're making some extra money. And accounting does not we don't do cash basis, we do accrual basis. So we expect that you spread that 1 million over 3 years. What can help us do that is this 8.08%. So the examiner will not bother you on looking for this 8.08, though in real life, in practice, you have to calculate this effective interest rate yourself. But in your exam, in ICANN exam, they will give it to you. So this goes to show that this 8.08 given to you contains both the nominal interest rate of 5% and also the premium. They have factored in the premium. So this has already taken care of all your income, all your interest. So with this now, we can know how much we are recognizing every year. So it has taken care of the 5% and also the premium. So look at it now. So with this now, in year one now, our interest income that we recognize to P&L will not be 5% of 10 million anymore, but rather it will be 8.08% times what? Times 10 million, which will be 808. So with this, we will debit. You can't debit bank because you are not going to receive the whole of this 8.08 in first year. You're only receiving 5% of it. The remaining 1 million is received much later at maturity. So what we do is we debit interest receivable with the 808 and you credit interest income to P&L with the 808. However, still in year one, when the interest is received, when the interest is received, you need to calculate the interest received. How much interest will be received? The interest you are receiving is actually only the 5% of the 10 million, which is 500K. So when you receive this, you can then debit bank with your 500K, then reverse this interest income, this interest receivable, credit interest receivable, also with what? With 500K. So okay, so your interest receivable will have a balance. The interest receivable will have a balance. How much is the balance in the interest receivable account? We have a balance of 308, which is this 808 that was there before, minus the 500 that we received. So it will have a balance of 308, which can then be transferred to the financial asset accounts. So ordinarily, the value in your financial asset accounts was how much? The value in the financial assets was initially, how much investment did we do? Was initially 10 million, but with this transfer of 308, it becomes how much? It becomes 10,308. Okay, then that ends year one. Then we go to year two, we do the same thing. But in year two now, when you're calculating the interest you will get, it won't be 8.08 on 10 million anymore. because the balance in your financial asset account is now 10,308. So you are actually going to be getting 8.08% on 10,308. So there's a simpler way of doing all of this. Instead of going through this every year, even though this is good, it shows that you understand core accounting, but there's a shortcut to do it. So there is a shortcut to all this. By using an amortization schedule. So we can say here, balance go forward, interest receivable, interest received, balance carried forward. So in the first year now, in year one, the balance was how much? Let's say 10 million. Let me do in thousands like this, so that's figure out big enough. So, and this one is at 8.08%. The interest received is at 5%. So the interest receivable, as I've explained earlier, is 808. This 808 here, I did 8.08 of 10 million, 808. This one is 5%. The interest you are receiving, 5% of 10 million, which is 500. The balance, by the time you add 10 plus 808 minus 500, you have that 10,308, which is here. So this one is a little bit faster than this, even though this one is better because you use this to understand this table. If you just cram this table and you don't know this, then you're deceiving yourself. You need to understand that this is the flow. And at that point, you're able to understand that it is this 808 that goes to P&L, while this one is just netting off the interest receivable. Okay, because that's what you actually received. And the balance will be transferred to financial asset account that makes it this. So in year two, we have 10,308. If we do 10%, of 10,308, let's check. What would that give us? I said 10%, 8%. It gives me 833. The interest received, listen up, this one is always fixed. It doesn't change. It will still be 500, 5% on the nominal value. This does not change. It remains constant. It doesn't change. It will always be the same. So by the time you accumulate this, if you add 10,308 plus 833 minus 500, this gives me 10,641. In year three, we have 10,641. If we do 8.08 times 10,641, approximately this gives me 860. This doesn't change, it's constant. I get this. So if you do 10,641 plus 860 minus 500, it gives me 11,000. And this 11,000 is jiving with the 11,000 at maturity that they will repay, which is where I want to be, because I need the balance in my financial asset account to be 11,000. So this table It's very important in a situation like this. So this is where you would have some complexity around amortized costs. And aside this one, the other one is very straightforward for subsequent measurements. It's the fair value to OCI, fair value to POL. They are straightforward in the sense that you are still going to do this. You are still going to do this table. Just that they might now tell you a new fair value. They can tell you that in year one, the fair value is 10,004. So that means instead of using this, it's 10,004. You will need to update it to. And if you are measuring it at fair value to OCI, that means the changes in value will be recognized to OCI. And if you are measuring it at fair value to POL, the changes in value will go to POL. But ultimately, this is the most important factor here. And that's measurement of debt investments. Do we have any questions, please?
Hello, sir.
Yes.
Hello.
Yes, please go ahead.
Please, in the amortization schedule, we gave us two identical interest receivable, interest receivable. I don't know whether it's good to go with that or it should
Which
be
one
an
is that?
effective interest. Yes, that one. The same thing with the 5%. Is it the same interest receive?
No,
Are
this
they
is
all ones
interest.
something?
This is interest receivable. This one is interest received.
Okay. Are they different? They are different.
Very different. This one is the actual interest you will get. This 8.08% is both this 5% and the premium.
Which is also the effective interest rate.
Exactly. Which is the effective interest. That's the effective interest rate we used here.
Okay.
Any other questions? Okay. You know what? I'm going to stop here just so that you can get a good hold of this, just so that you can revise this, watch the videos, ask questions if you don't understand. The next week, I would do the remaining financial liability, then we solve questions on this area. So tomorrow, I won't have class with you guys. So I've informed you before now that I might be scheduling classes for you guys on Sunday from 5 to 7. So just for us to move a little faster. Not only that, not even about moving faster, I might be using that time to be solving past questions with you guys. Since that time is opened, like we have done a lot of topics already. We need to start solving past questions. You need to start getting used to that. And I've told you that questions from 2015 to 2025, solve it. So yes, I know you will solve it, but I just want to wait for you guys solving it alone. I want to start solving it with you guys. So we might be using Sundays to do that, right? So as of now, I'm saying we might not have class tomorrow, but if I decide to let you guys know that, guys, let's have class, I'm sure you would be, okay, you say you already have audit by 7 p.m. Okay, that's fine. Is it from 5 to 7 or 7 to 9? If it's 7 to 9, then that's still fine. And that means you can do SBR 5 to 7, you do audit 7 to 9. Then that still works. Okay, so let me share this with you. I'll see you guys in the next class. Thank you very much. Have a wonderful day ahead of you. Bye.
You too, sir. Thank you, sir.
You're welcome.
Thank you, sir.